Hello, Baker Financial Institution students. Hope everyone is doing well. I recognize many of the names and faces from the past, so I'm glad to be working with you again. What I do is I post these every Sunday, kind of give you an overview of the week. That is a video mini lecture. And today I just kind of want to give you kind of a quick overview of the course and some highlights about the chapters and expectations. Without further ado, just with the course, just make sure to review the course syllabus. You'll see it's a progression that you'll have like weekly forum discussions, you'll have homework problems, you'll have a quiz, and it accumulates to a final paper that you'll do at the end that you'll pick a financial institution, a commercial bank. I suggest one that's publicly traded to get information. But with this time period, it's an interesting time period right now, especially with COVID, with the financial institutions, financial markets. I mean, the stock markets are doing quite well. There's still the question about whether another $1,400 stimulus would go out. I was listening to recently Janet Yellen, the former Federal Reserve Chairman, now the Treasury Secretary, really emphasizing the importance to get this stimulus checks out. We don't want to delay or lag things because that can definitely help the economy out. And if the economy is doing well, in theory, that the stock markets will do well, and there'll be greater employment. I was also listening to another economist. She was saying that the people tend to like the checks. So I think we'll see that as continued in the future as a form of fiscal policy, at least, to try to stimulate the economy in the future. And whether people save it or not, or spend the money, um, I think it still gets back directly into the markets. One thing with so much money being out there right now is interest rates are very low. So it will be interesting to see how this COVID progresses over the term of our course. Hopefully, we'll move in the right direction, and hopefully, we can keep stability in the markets, and hopefully, we've accurately priced in the markets right now. It'd be interesting to see what's going to happen, especially in the stock market. Whether they're overvalued, I know prices have gone up quite a bit because interest rates are so low, and it's kind of a seller's market. It's hard for buyers to find a house, but that's what we hope. Some of the regulation and institutions, things are in place that you read about in this course, does not cause another financial crisis. All right, make sure to go through the syllabus, ask questions if you have any questions, but jump into that forum discussion. I think your first initial post is due by Thursday. I really want you to pick something that's current, like within the past month when you do the forum discussions. This semester, I'm still working on my doctorate, so I'm super busy. I, I probably will not be able to post back reply to everyone every week, but I'll try to jump in and try to pick people at random and try to get to everyone throughout the end of the course. So hope I'm in the same boat with you all, going to school, and hopefully be done by May or this summer. So if all works out well, we'll be Dr. Barnhill. So anyway, with some of your readings this week, in chapter 1, kind of really looks at the idea of like financial markets and institutions, understanding the markets. The reason, if we think about this from what I would call a conceptual framework, when we study the markets, we're really, page 9 gives a good overview of that. But we're really trying to understand like equilibrium and prices for assets and markets and the determination of these interest rates, and to provide stability too in these markets. So you think about like a conceptual framework of theory, what the authors were saying is that, even though finance terms, for the most part, they stay pretty static, but there are things that change all the time in financial markets. But the underlying premise is they want you to think about how are asset prices determined, and then for you as individuals, as it applies to you as personal finance, how do you make better decisions? Or for corporations or those that work in the finance industry, we're borrowing money, raising capital, those type of things. How do I know that I'm making a good decision? It's tough. We don't have clear crystal balls that tell us everything. We try to use the best available information, and especially, is this a good decision? I think about investment that goes all the way back to finance, understanding present value, and is this a risk, or how much risk is associated with this? One of the things I was reading about, I think it was maybe a documentary about, I think it was Blockbuster. They went out of business, but they had an opportunity to buy Netflix many, many years ago. And obviously, they misunderstood the market at that time of that opportunity, and they flat out said no. It was one of the biggest business mistakes ever made because Netflix is worth a lot of money now. So, but those things are hard to see, and you try to use the best available information. And that's what this course does, is try to help you understand that information to make better decisions, especially interest rates and the risk associated with it. So Chapter 2, we'll get more into the overview of the financial system, the concept of financial intermediaries, the exchange between borrowers and savers, and financial institutions help reduce some of that risk, because if not, you'd have to go out individually and try to find somebody that would um, be a good borrower of your funds, and the risk involved with that. It's like kind of lending money to a relative. You don't know if you're going to get that money back, but you hope that you will, or sometimes it's just forgiven. But most of us want some reassurance that if I'm going to lend some money, and that's where financial institutions can take on some of that risk and determine the credit of individuals in order to make those decisions. But an overview, they kind of give an overview in that chapter 2 about debt, equity, the primary, secondary, the exchanges, money markets, anything matures 1 year or less, capital markets, long term. We look at international, foreign bonds, euro bonds, euro dollars. You'll read about that, and then you'll look at the concept of, again, that with financial intermediaries, that some of the principles and the theory when they'll talk about transaction cost, or the idea of asymmetric information, that one party has more information than the other that know about whether you're good with your credit, whether you're bad with your credit. Concepts of adverse selection, making bad choices, and then moral hazard, that if somebody has the money, are they going to do all the things that they need to do to pay back the loan? So I remember when I was very young, I worked for Fulton Bank when I was 18 years old. I worked issuing loans and credit cards, but I worked right next to a repo department where they basically have the very big guys go, and if you didn't make your car payment, they'd come and they'd tow the car away and take the car away from you. So they have built-in ways to try to recover their assets. But with these investment intermediaries, it made me think. Even the other day, I was shopping at Hy-Vee, and if I remember correctly, I remember Hy-Vee is something on the side of the wall saying that let us help you with your financial decisions. I'll have to go back and check that again, but how the markets change with financial intermediaries, it's getting more open, more complex, more with the advent of technology. So you see things now, even with buying cars, which involves typically a loan. About you can do it on the internet and just have it delivered to your car, or you go out to one of those. I've seen those big towers with the cars. It's like putting in your money like in a gumball machine and picking out which one you want. But markets are interesting, and how technology has definitely changed that. I think it will continue to change that. So. The last chapter, chapter 3, a little bit of review of finance, so to kind of brush up on these things. It's been a while, but obviously the idea of present value, again, just a reminder, present value as interest rates go up, present values go down. So, in helping us make decisions about what is something worth to me today, what is the value of this, make sure I'm not overpaying for an asset, better underpay, that's that get a good deal, but make sure if you're selling at the right price and the equilibrium. But you can review things like rate, payment, perpetuities, things that never mature, like British consols were examples of this. You would never actually get your principal back. You could say like a preferred stock is like this. Understanding current yield, the interest you receive divided by the current price. Rate of return, understanding it's whatever income you receive plus any capital appreciation. We measure rate of return. And interest rate risk. And something that may be new for some of you, in the last of chapter 3, you're going to look at the idea of duration. And basically, duration is the weighted average maturities of the cash payment. So if I were to look at a bond at a given interest rate, and the question be, you can calculate this average duration, and the textbook goes through to explain, that the greater the duration, the greater the reinvestment risk. So they'll walk you through some examples of that. Say if interest rates are to change from 10 to 11%, what is the impact of, say, a bond portfolio or a bond that you hold? So All right. Well, that was the 10-minute overview for this week. So I'm looking to talk to you guys online again. So I'm open to do some Zooms too if you have some questions. I do have a Baker Zoom account now. I know it's an online course and it's kind of hard to get everybody together at the same time, but I may open that up later in the course if people have questions. But if you do have questions, do email me. I'll try. I check email usually daily, so I'll get back to you that day or the following day if you have a question. But hopefully most of it is pretty self-guiding through the course, the materials I put out there in Moodle. But otherwise, I want to say I look forward to working with everyone and have a great week, and may the markets do well. Take care.